Joining us today on Wall Street Silver is Tavi Costa, founder and portfolio manager at Crescat Capital. Tavi, how are you doing today, sir?
I'm great. How are you guys doing?
Well, we're doing really, really good. We appreciate you taking the time to talk with the community.
The Fed's not the only one who's printing a lot of money, and we're having some supply chain issues. How do you see those two factors affecting inflation, and will that change going forward in any meaningful way?
Those are important parts of the inflation part, but I would break down into three parts. The first one would be the demand side, which starts with the personal savings. We've had personal savings really go up to about $6.5 trillion back in 2020 in March and April. And then that really unleashed about $3.6 trillion of consumer spending, which is about 7.5 times what we saw in annual consumption of households throughout history, adjusted for inflation. And so what we think this is going to happen, and why am I talking about this, is that U.S. savings are now up again, and it's at a $6 trillion mark one more time. I believe with the economy reopening, we are going to see somewhere close to $4.5 trillion of consumer spending. And that's an important part of the picture because the bottom 50% of the population has improved drastically in terms of their balance sheets, in terms of the net worth. And so what we're seeing is a relocation of the imbalances from the private sector to the public sector. In other words, the households in the US have improved significantly. And so if you look at the net worth of the bottom 50% back after the global financial crisis, we've had a decline of about 84% of net worth in those lower classes. And this time around, we saw the largest increase in net worth. And some folks like to say, well, that's a lot of financial assets. That's not true at all. About 40% of that is in real estate, and the other part of it is in cash and other very liquid assets. And so the improvement, even on the balance sheet side, in terms of liability to asset ratio for the bottom 50% is at the lowest levels in a decade. And so we are seeing improvements across the entire society, really. And then the second part of it that you were discussing was the cost push type of inflation, which is certainly something that is also reinforcing the inflationary pressure. One of them is the supply issue. I mean, we discussed this back in December of 2020 when we made a whole roadmap, macro-wise, to go back to the 1919 Spanish flu, where we saw a reacceleration of consumer prices, not because of aggregate demand was growing, but because the supply was so constrained. Okay, well, we got that right. So what's next? I think what's next right now is labor pressure. I think that there is going to be a lot of labor pressure going forward, especially with the fiscal policy right now, which really magnifies the issue of labor shortage, where folks are not really trying to return back to the labor market right now. And the third one is the monetary debasement that we're also seeing a full cylinder too. If you look at the QE purchases that we're seeing right now, the program from the Federal Reserve, everything is at levels that we haven't seen in the past, and likely to continue given the levels of debt in the government. So the Federal Reserve is trapped, and it has to continue to print money in order to monetize the debt, in order to purchase treasuries and suppress interest rates. Look at what happened 2 months ago. We had $600 billion or so of treasury issuances. And, Federal Reserve could only buy about 25% of that. And guess what happened? Interest rates started to rise. That is not what the Federal Reserve wants. And so this tightening talk, or going from yield curve control to tightening or tapering, whatever you want to say it, I believe it's, I don't think that it's going to materialize. And so those are my views on inflation.
I saw that you had tweeted something you just actually said. You led into my next question. The Fed is trapped, and you had that pinned on your Twitter for a while. And I'm guessing you're referring to this no-win situation where if they raise interest rates, they're going to blow up the economy. But if they don't raise interest rates, inflation blows up the economy. How does this get resolved? I mean, who wins? I don't see any scenario where they raise interest rates. I don't think you do either, because I read your Twitter regularly.
Yeah, well, thank you, first of all. And I would say that the first part, there's a lot of imbalances in the system that I think really limit the Federal Reserve to tightening at this moment. Let's think back of what happened during the March crash. Corporate bonds, the corporate bond market basically dried up the entire liquidity of the market. And what we saw was a real problem where the Federal Reserve was forced to communicate with the market that they were going to start buying corporate bonds through ETFs and so forth. That was a change in the whole communication process of the Federal Reserve. This is still the same, meaning corporate debt relative to nominal rates is still well above what we saw in the peak of the housing and the tech bubble, at the same time as you have corporate bond yields near record lows. And when you look at the line of these two factors right now, clearly they have followed each other very closely. In other words, as debt increased, corporate bond yields increased as well. Now, since the global financial crisis, we've had a divergence between those two. And that's really caused by the easy money policies we've had for the last decades or so. So how do you unwind this situation by raising interest rates? And what do you cause in terms of raising cost of capital for corporations in this environment? That's question number one. Question number two is regarding the twin deficits. It's not only fiscal deficit, but there's also current account deficit in the U.S. And when you add the two, you've got over 25% of GDP of a twin deficit. You can't really you can't taper in a scenario like that, especially when foreign holders of treasuries are actually reducing their position as an investor of U.S. debt. So who is going to fund the U.S. going forward? It has to be through debt monetization, and where the Federal Reserve comes in a very important role of purchasing a lot of those treasuries. I don't think that's going to change. So those are really the importance. And the third one is the valuation in the equity markets. We at Crescat run a lot of quant models to try to identify where we are in terms of the business cycle, but also using value principles of fundamental factors in order to see throughout history if we really are at a very expensive levels. And it is undoubtedly the most expensive equity market we've ever seen throughout history. And some may say, well, that's justifiable because we are in a positive deflationary environment. Are we? I don't think we are anymore. What is the bullish thesis for equity markets? Well, here, we're listening now, the Federal Reserve is likely to taper. That is not positive. Are they going to let the economy run hot? And so inflationary forces will continue to creep up? That is also not very bullish. And, I think that the research of a lot of investors of going back in history and looking at other different environments in history where we had inflation and looking at the performance of stocks and equity markets, look, that is not positive for those at all. 1910s and 1970s are both examples of what happened, of inflation running above median levels. And what we saw was that actually the equity market was up slightly, was up 1% during the entire decade. And at the same time, inflation was running well above 6%. So in real terms, the return for equity markets was actually negative. And commodities did very well. So I believe strongly that commodities will continue to outperform equities going forward.
About the wealth increasing and the savings rate increasing among, I think it was the bottom 50%. Do you see any of that capital flowing into the equity markets?
Well, we are seeing a lot of that. We've seen, especially the day traders post the March crash in April and June of 2020. So certainly there is a level of speculation. Well, look at the crypto market. So there is certainly a level of speculation being created by the easy money policies and the excess of liquidity in the markets today. I used to be very much in the camp of the deflationary thesis. Why? Because I think valuations, the reckoning of extreme valuations creates a very deflationary force in the economy. And I believe strongly that's still, a very something every investor should be worried about. However, the policies being used are really overshooting the problem. So we have not only retail sales coming back to well above historical levels, We have today came out new orders for durable goods. We're at 5% above the prior peak in terms of that, 29% year-over-year growth. And at the same time, the Federal Reserve continues to buy $80 billion of treasuries and $40 billion of mortgage-backed securities. On top of it, the housing market is on fire. And so they can't stop it because the US bottom 50%, if you create a crash in the housing market, you create even larger inequality issues, because if there's one thing that the US bottom 50% holds, it's not financial assets. It really is actually the housing market. They hold usually one real estate is what they purchase. And so this is a big problem, and it goes back to this dependency on monetary policy going forward. And on top of it, what do we have in commodities? You guys all follow commodities markets very closely. We've had underinvestments in the commodity space. And if you know the space of commodities, it takes you at least 5 years to develop a mine. 5 years, that you're lucky if you get in 5 years. Usually it takes way longer than that. You know, the average is probably closer to 10 years. And so how do we get from here those transitory impacts that we're seeing in terms of the inventory problems? I don't think that's really as much as transitory as most folks believe. I think it's a little bit more permanent than that.
Well, that leads into this chart that I just put up, which I got from your website, the gold supply cliff, in terms of the timelines, the delay it takes to bring new supplies online. It's really turning into a cliff.
Sure, that's definitely one huge part of the thesis. Even though a lot of us try to look at the macro imbalances and be so excited about those being drivers of the demand for precious metals, the supply side of it is probably even more compelling. And when you look at especially the projections of production for the majors in the gold and silver production space, what we find is that there is a massive depletion of their assets, especially the reserves. At the same time, there's not much spending on exploration and even discoveries of gold and silver. Basically, if you look at major gold discoveries, or 2 million, above 2 million ounces would be the definition of that. We've had zero in the last 3 years or 4 years now. And so how do we really, this is a real imbalance right now. How do we reconcile this with imbalances creating the demand? Well, it creates not only a mismatch issue of supply and demand, but also I believe the majors are actually getting extremely profitable right now. We're seeing, they're cutting their costs for over a decade or so, and paying down their debt. So the situation of profitability is becoming a big thing among the miners. And when you really start studying inflation and cost of capital rising, the same way we have cyclicality in the markets, we also have cyclicality in factors that work in terms of selecting investments, and especially in equity markets. What am I referring to? I'm talking about especially top line growth. So in the last decade or so, if you do your research, you'll find that a lot of the top line growth factors have been one of the best ones to pick stocks. I think that's about to change. I think we're going to see profitability coming back, to prioritizing bottom line strength and margins and so forth. Why? Because as you enter an inflationary environment, the cost of capital rises and investors begin to look for, well, how are we going to pay for this? And so that's exactly why I believe the miners will be the big winners of them all. Why? Because they're the ones that are really becoming profitable in this era. And look, the party hasn't even started. As all of you know, at least my view is that gold and silver are extremely undervalued. But what if silver goes above $50 an ounce? And you're a silver miner. Now you're talking about some real free cash flow growth. And so that you're probably not going to find in places such as retail companies or software companies, you name it. I don't think those companies are in the same level of growth opportunity than a lot of the natural resource companies, especially in the gold and silver space.
Well, this next chart that I just put up is essentially the silver supply cliff that I think we're already several years into. But you see that same supply cliff happening with silver as we just saw in gold. They just don't have the discovery levels that they had in previous decades.
Sure, I think that's certainly the case, and especially has to do with capital spending in the space. Which, when you look at capex for silver miners, down about 26% year over year, at the same time as silver went up 50% in prices back in 2020. I don't think we've ever seen anything like that in history. Usually, what we see is that miners become more optimistic, and then they tend to spend more money, and so the capex cycle tends to follow the metal prices. Not this time around. So those are the big parts. And we've had a lot of discussions with the majors. It's funny how things change over time. Back in 2020, we asked them, "Why are you guys not buying copper projects?" The answer was, "We're not interested right now." Guess what? 6 months later, copper prices are much higher. They're all interested in copper prices now, and they're all interested in copper projects. Now, let me tell you what's going on right now. I asked them, that next question was, are you guys interested in any of the exploration projects that we are involved with? And we have really high grade quality projects that you guys can get involved and perhaps stop this depletion of the supply cliff problem that I was referring to. The answer was, "Oh, I can't really justify to my shareholders if I spend money on a property that it's not going to deliver any free cash flow in the following 3 years." And so, at what point, do they change their opinion? I think it's going to be. And so, but we see this over and over again in the natural resources space. And the funny thing that you're referring to silver, it's also happening in oil. Oil capex is also declining significantly. I can see copper as well, or base metals as a whole, also looks pretty dismal in terms of capital spending. And those are all very capital intensive industries. It's funny to me, having such a capital intensive industry that have bleeded so much cash flow throughout history. In other words, they have lost so much money throughout history. And I'm referring to especially the gold and silver mining space. We're now turning around. In other words, they're actually becoming profitable. We're actually now, I think we're going to have our 6 straight quarters of profitable free cash flow for the first time in history of the mining industry in the gold and silver space. And so finally, we're seeing them actually paying down debt. Back in 2011 or so, we saw them leveraging up rather than paying down debt. This situation is changing. They're cleaning up their balance sheets. They look much stronger than we saw any other time in history. In fact, if you compare the balance sheets of the miners relative to other sectors of the economy, you name it, consumer staples, tech companies, anything else will actually look above in terms of debt to assets ratio relative to the gold and silver miners today.
It sounds like you believe there's a bubble in the equity markets. You feel the same thing about residential and commercial real estate? And are there any other asset classes that you think are in a bubble or in peril, if you will?
That's a good question. I think the equity markets are. I mean, we make calculations. We have 15 factors in our valuation model, and about 11 of them are at 100th percentile going back to the 1900s. And so 4 of them are pretty close to it too. We've never seen such an aggregation of factors at all-time highs in terms of valuations. I think the corporate bond market is extremely overvalued. I think the treasury market is also extremely overvalued. I think the sovereign bonds in general are in the same situation. We have a problem as well with the housing market. I think it's more regional. I think there's some parts of the world that is still probably look attractive. I'm not an expert, and I'm not invested in real estate at all. However, I do think that it's regional, and then some areas. If there's one part of the market that deserves hand holding here, will likely be the housing market, and that's given the fact that the bottom 50% holds a large majority of their assets into that. And so
Google search popularity of the word inflation. And we've noticed the same thing on Reddit, where searches for the word inflation have just gone through the roof. And it sort of tells you that this is right. The everyday person is becoming much more aware that inflation's a thing again. how do people respond? Do you take that into account? Like people are going to start responding differently to these financial pressures in terms of the choices they make each day. When you see a graph like this where it's just skyrocketing in terms of public awareness, what does that tell you?
Well, it's an interesting chart, and the reason for that is because when you see a chart like this, the first thing you wanted to do is to probably fade the move. In other words, do the opposite of what the chart's telling you, because it certainly seems out of whack with historically, at least from this chart. But that's not the situation. If you study inflation, as you were saying right now, as investors begin to have issues with inflation, and inflation becomes a more prevalent narrative among folks in general, investors begin to hoard tangible assets, and that's what drives the prices of commodities especially higher, and also tends to create upward pressure on consumer prices. Funny enough, the own measurement by the Federal Reserve with inflation, which they calculate their median CPI, is actually at a 7-year low. And so it's almost like a joke, but inflation expectations is almost like a feedback loop that continues to feed on itself, and really creates inflationary issues as you have companies being pressured by labor forces. And that's the whole reason why I think we had 30 years of wages and salaries declining, and I think that we're going to see labor pressure that will change the inflationary picture as well, and adding to this issue that you were talking about. And the problem with that is that as the cost of living begins to rise, which we're all experiencing this right now, it will create a need for workers to demanding higher salaries and wages. We saw that back in 1919. 1 out of 5 workers, or actually 1 out of 5 people in the labor force back then was engaging in a strike, in a labor strike at the time. And so it's a matter of time until we start seeing this here. We saw some news already on McDonald's and Chipotle and some other companies that are starting to have issues of labor pressure. I think that's only the beginning. We're going to see a lot more than that, because you can't see the cost of living rising to the level we're seeing without seeing a follow-up through folks in general that will be asking and demanding much higher salaries and wages. And so this is going to pressure companies. It's going to create a squeeze in their margins. And so again, I think that this issue that a lot of the Federal Reserve calls it transitory, I think it's a lot more permanent than most believe. We haven't even started seeing the labor cost pressure yet.
Yeah.
If you look at labor cost, wages and salaries relative to gold, I just a little hesitant to use CPI for this, so I use gold prices. It's down, I believe, 40% since the 70s. And so, so we're seeing, we all know inflation has been in the system for a long time. And so, the average Joe doesn't own gold. And so how do we protect ourselves? So I think that right now the pressure is becoming prevalent in the system. And as that happens, I believe strongly we're going to see a lot more pressure from workers to increase their salaries and wages that we've seen in the last 30 years.
Well, part of that is the government's giving so much free, extra unemployment benefits. On top of state benefits, there's the federal kicker for a couple $100 per period, and all these stimulus payments that people are getting $1,400 or $2,000 checks, and a lot of low wage jobs are having trouble competing with that, in that people aren't willing to come back to work because they make more on unemployment just sitting home. Or even if they make a little bit less sitting on unemployment, does someone really want to go work a low wage job for 40 hours when they only make a tiny bit more for all that extra effort? And I think the answer is obviously no. So that puts pressure then on all those companies to not just beat unemployment benefits by a little, they got to beat unemployment benefits by a lot to lure those people back into the labor force, correct?
I agree. Well, if you listen to what policymakers are saying. Neil Kashkari was interviewed the other day when we had a disappointment on jobs number, and really what he was trying to emphasize is the fact that, well, the whole reason why we have the policies in place is due to the numbers in the labor markets are not improving yet. And then the next question was, well, do you think that the policies in place are also intensifying the issue of not really suggesting or indicating that that the folks should return to the labor market? And the answer was yes. So the answer for the problem is really worsening the situation. So I don't think they're looking at backwards. In other words, they're continuing those monetary policies that are also the whole reason why folks are not returning to the labor market, as you referred to. How many restaurants I've been to recently, at least walk by and seeing the signs on the streets saying we are short of labor here. And so, this is happening in the whole U.S. and it's an issue that we also see in other parts of the world. Even in Brazil, this is happening as well because the policies are very similar. Usually other countries tend to follow the U.S. along, especially the leadership of policy making here in the U.S. tends to spread around the world. And so, 30% of the personal income of U.S. households today comes from the government. How do you change that? How do you even remove that from people in general? It's going to be difficult to reverse this trend. And so, when you look around in terms of prices, used car prices are surging. Prices of anything is surging. Commodity prices, we all know that are surging, but consumer prices in grocery stores or even services are surging as well. And so it's going to be, I believe that there is certainly some inflationary pressure that could be, I think it could be fixed if they would have been doing some tightening right now and creating probably, the bust of some very speculative bubbles in equity markets, corporate bond markets, and the housing market. But they're not going to take that route. We all know they're not going to take that route. And so, there's a high probability we're going to see inflationary forces getting out of control. And as we see that happening, it's going to change the whole investment landscape, in my opinion.
If we see a sell-off in the corporate bond market and equity market, and that kind of collapses, what effect is that going to have on consumer price inflation?
Oh, it's definitely going to be negative. But and I think not only you, but nobody knows what is going to play out in terms of inflation and deflation. Certainly, I think the two narratives have never been so strong. So you have, the valuation part of it is in terms of especially financial assets, as we were referring to, equity markets and corporate bond markets and treasuries in general. Everything else is expensive, and if we do have a reckoning moment of those where there's a reset of valuations, I think that's very deflationary. And so that's why it always comes back to one chart, which is the commodities to equity ratio. I don't need to be right on an inflation trade. Maybe what plays out is a deflationary bust. Who knows? Maybe the Federal Reserve wakes up in the following weeks. What we see is tightening, and now they're trying to fight inflation, and I'm completely wrong. And what that does is that we're probably going to see a significant decline of prices in equity markets and corporate bond markets, you name it. Everything is going to fall apart, along with commodities, especially the cyclical ones. Now, do I think that that's going to happen? I think it's a lower probability than overshooting the policies. I think we're going to see the opposite. But I respect that narrative, and that's why, as a fund, we continue to have shorts in our portfolio. And at periods, those shorts did not work, and it's part of the game. Now, the other side of the trade is the commodity side of the trade, which is, especially for me, is monetary metals, where I think it's the most attractive side of it. And if we do have those policies being overshoot, and maybe we start really seeing long-term inflationary pressures build up in the system, well, then you have the other part of the ratio working out, which is commodities. And so I believe that that's probably the most relevant chart in my deck of charts that I can think of is the commodities to equity ratio. And any investor should be looking at that and really thinking about how do I allocate for my following 10 years in the markets? How do I really position for this? Equity market crash. So here you go, S&P 500 is in the blue line. This was a very severe recession back then because a lot of asset classes actually suffered from this environment. At the same time, we have Barron's Gold Mining Index, pretty broad index, doing very well during that year, during those years. And so I think that that's kind of the case here. One last chart I was going to show is that chart of prior inflationary periods in the system. You can use CPI, which is a bogus calculation, but especially after the 80s, I would say back in the days, there is a chance that this was probably calculated in a little bit better way. But anyways, putting that aside, look at the median calculation of consumer prices above 6% only happened in 1910s and 1970s. In the 40s, we saw sporadic increases. And here's the return of the equity markets at about less than 1% in both environments. Markets basically went sideways during that period. And what is interesting about this is the inflation and real return is really negative. And again, it goes back to commodities, where both of those times actually commodities did very well. I think we're about to see another one of those.
So Tavi, I'm going to share one of your charts, silver to money supply. I think for our audience, this is really critical. And I want you to explain this chart to Wall Street Silver.
Well, when I really started looking at silver, a few years ago, and I start realizing how silver did very well during inflationary environments like the 70s, and obviously is the high beta version of gold. So there's a lot of reasons to be long silver right there if you're constructive on gold. But when you look at silver being a monetary metal for so many centuries, I realized that maybe the right way to look at silver is relative to money supply. Immediately, what I found was that silver really bottomed in 2020 relative to this ratio, and it really did a double bottom, similar to what we saw back post-tech bubble times when gold actually had a very strong bull market back then as well. I think silver is really in the process of making, in my opinion, what is going to be new highs in terms of nominal prices of silver. I believe strongly that we are in a consolidation mode, about to break out, and a lot of folks, I think that the real investors that make money in the space are not the ones that are buying the breakouts, are the ones buying the pullbacks. Okay, so when we had the pullbacks here, I was adding to my position. Was it painfully to watch it? Yes, but I believe that this chart is one of the big reasons why silver is so cheap. Silver is also cheap relative to gold. So in our view, there's a pretty strong case to be made that silver could be trading our target price for silver, given in terms of where we are of monetary supply, monetary base, size relative to the economy in general. We believe that there is a case to be made that gold could be trading at much higher levels, but silver could be even at $200 an ounce.
So this was the peak for silver back during 2011, correct? But we're looking at this relative to money supply. So the way you have this set up, it's not just a standard $50 nominal price per ounce, or 49, wherever it got to in 2011. If you're taking into account the money supply growth also. And if this were just to get back to the same level in terms of silver to M2 money supply, with the dramatic hockey stick formation of growth of M2 money supply, what would that equate to today in nominal silver prices?
So let me just say, well, I think the creation of that calculation really was coming from looking at central bank assets relative to gold prices. And so what you find there is that gold prices should be at least at $3,200, given where we are in terms of the monetary base globally, not just in the US. So our goal was, or our calculation then was, well, if you calculate the gold to silver ratio to medium levels, especially you can use the mining ratio. There's so many ratios you can use. We came up with $188 an ounce would be the target price, given the monetary imbalance that we've had created in the last decades or so. Do we need to get there? No, this is a moving target. You know, if money supply doubles again, well, my price for silver is going to double again.
Mhm.
I think price targets are difficult to, it's important to have one, but it's not really what it comes down to me. I think it's really the macro environment, and which I think it's incredibly attractive for not only tangible assets, but given this inflationary pressure now in the system, it also creates a pretty interesting setup for things like silver. I think silver is the most asymmetric opportunity out there today. I would hold silver rather than gold all day long. And I think that if you're able to find really high grade deposits of silver, you're probably in an even better spot. And so that's really where Crescat has been focused on. Silver is also cheap relative to equity markets. If you look at silver relative to the Russell 3000, it's also forming a double bottom. And so I think that, going back to the commodities to equity ratio again, but now specifically looking at silver, there's a lot of reasons to hold silver, in my opinion. Is that only metal that really fits in between not only being a monetary metal or an alternative for the monetary system, but also it's where you get from to go from the old to the new economy. The green agenda, the political environment. I think it fits perfectly with that as well. And so for me, it's the one asset that I'm very focused on for the next few years. And I think it's going to be, I think it's going to go a lot higher. I think it's going to make new highs in terms of prices, obviously. And I'm very positioned for that for the following months.
Yeah.
So buy your silver now before it's too late, is what you're
Before
saying.
it becomes unobtainium, right? So
Just wait, because I'm going to buy more before we end this.
well, Tavi, thanks. This has been a real treat. We appreciate you coming back to join us, and let's do it again in 2 or 3 months as the year. It's shaping up to be just an amazing year.
Sure, I agree with you, and thanks for having me. I look forward to the next months. I think instead of being doom and gloom, there's a lot of opportunities in the markets right now, and that's where I want to be focused on. And let's touch base again. And thanks again for having me, and I really appreciate that.